Okay, this video is about playing with stock price data and uh, evaluating betas and volatilities during different time periods. Now, I'm going to go through a whole lot of stuff and show you how to get the data, how to graph the data, how to compute betas in a millisecond, and blah, blah, blah. But the real mystery here, which I just don't think has been addressed enough, is number one, if you use for this wonderful famous beta statistic where all these, academics try to prove blah, blah, blah with their integral blah, blah, blah. They, they do stuff. And now, if you use daily data, take the end of the day, end of the day, end of the day, and do a slope of the change in this is Con Ed versus the S&P 500, you got a beta of 0.46. But if you this is over about a 5-year period, okay, a little bit more than 5 years. So we'll change this. And of course, in the video, I'm going to go through how to do all of this stuff for you. Okay, then it changed a little, darn. Okay, and if you, I suppose, would even go back further, and the other way around, you get the same kind of uh, uh, phenomena. Okay, and that is that when you compute the betas, now don't really, I almost, let's take this away almost. When you can take the beta on a month by month basis versus a daily basis, you get a very different answer. Did you learn that in your little investments class? Okay, and did they tell you which one to use? They by default use this one, but why'd you get a different answer? If the market, and I'm going to have to make a Monte Carlo simulation on this, if the market was all nice and perfect and things were random walks identically and independently distributed and all the blah 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 blah, they'd always give you the same, and you get these completely different numbers. I'm using GE and Con Ed because I'm going to go through and show you that we can get daily data since 1950 and 1962 on these stocks, and then we can put this together. The other thing that I'm going to actually spend probably too much time on and more time is that when you do a daily volatility, and it's not surprising that the S&P that follows portfolio theory, that you get a lower volatility on a big portfolio rather than an individual stock, all that blah 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 blah. The uh, 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 but when you compute the volatility and you correct it by annualizing it to the square root of 252 for the day, square root of 12, blah 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 blah, you get a lower volatility if you use different time periods. Now we can go up and down and check things. And, I'm going the wrong way. I want to go all the way back. Okay, I maybe should have put a little reset button in here in 1963. Okay, and then we can kind of see what the patterns have been here. It was a little bit lower, and then we can put different time periods in and see the phenomena, see if the betas are changing over different time periods and all the rest. And this is, again, I think, I'm sorry, I'm being down on a little bit of my classes on this that I took in 19, I don't want to tell you how long it was ago, and I had to read the Fama book, and oh God, to try to make it through that. But we get the we get differences, and my proposition is that there be this difference between volatility on a monthly and a daily basis shows you that there's a little bit of trading, profit taking, these people getting really rich by doing their algorithms and everything else on a daily basis. By the time it gets to monthly basis, the there's a lot less you can do. And I've got a whole nother thing which does this. Instead of taking this year versus 1 year next year versus 1 month next year and all that, it's on an average. So this is just a little introduction to this thing. Here's the GE stock, which is kind of a sad story, really sad story if you want to know. If we go back to like the year 2000, where before, oh, look at that back then. Oh my gosh, then we have enormous GE doing so much better, and we still have the same kind of beta thing going on, and you'll see how we look at the IRRs and percent changes and use logarithms and all that. So that's going to be in the rest of the video. Okay, it's evening, and I'm thinking, well, what should I do today? And I can't think of anything better than drinking maybe a little glass of wine and thinking and working with Excel sheets on daily, weekly, monthly stock prices and evaluating if there's really mean reversion or no mean reversion in the data. Are the data really IID? I think that's independent and identically distributed or something like that. I remember that from I think in the 70s or 80s or something like that. And I'm going to walk you through some stuff, a lot of this that'll be non-practical, so turn the video off, okay? But some of it, we'll compute some betas. We'll compute betas on a daily, weekly, monthly. Weekly is pain. How about monthly and daily basis? We'll look at stock prices and evaluate if stock prices have they have mean reversion or not, and look at the implications and understand whether we should be computing betas. For what it's worth, you might argue correctly that betas is kind of does it really measure risk? God knows. Who can prove that? Nobody can prove that either way, but it seems to have been resulted in over the years a way it's close enough that you think companies that are less risky have lower betas. Okay, enough of that. Whether you can diversify the portfolios, blah 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 blah. Now here's what's exciting. Okay, this is not exciting, but these Ibbotson and whatever they are, Sigfield, something like that. I remember they gave you this data, and they gave you data. Now you can get their data from 1928 to 2020, and you can find that. I don't know if they used to charge for it, and in the old days, that was the only data you could possibly get, and you'd compute these arithmetic means and all this crap. Oh my God! And then you'd have to rely on their data because you couldn't get it anywhere else. Okay. Then now comes our friends at finance.yahoo. Whoops, I'm showing finance.yahoo.com, and we don't need this one, and we put S&P 500 in there, and what happens is, if you go to historical data, I don't know why they don't say historic. I think historic is the correct English, but whatever. And there's where is the download? And this is so cool. If you put max here, you get 1927, December 29th. Ooh, you got 2 days, maybe. I don't know what was a weekend. If you press apply, you can do it, but and then you can get daily and monthly and weekly. But where's the spreadsheet? Because if you do, let's do the other stock, I guess we'll use, okay, I'll do it like this. We'll use Con Ed because they were around a long time and they avoided a dividend. And of course, if you go to historic data, right there. Oh, there's a little download. What in the heck? We have this wonderful data. Now, somebody, I forgot who, sometimes people just do good things. They gave me I'm still recording. They gave me this method, okay? And I put this method on my website and gave it to you. And now what you can do is if you go to monthly S&P, okay, this is my standard stock price download stuff that nobody uses. I guess you think you can get it from Bloomberg and everything else, of course, now, which maybe you can. And you click on the stuff to download. Oh, this is a mess a little bit. Maybe that's why nobody likes my stuff. Down here, you go to Yahoo Index, and what I do is I say, oh no, maybe I want the index for the DAX, the S&P 500, or the NASDAQ, or somebody else. And you just kind of put together a little bit of a tricky, this is why I'm just kind of copied this method, and you put a little macro together, and I'm going to clear all the sheets and stick this stuff and read all the sheets. And then when I do that, here's what happens. It gave me the data. Really, I'm getting all of them, the Nifty 50 and Nifty 50 NASDAQ. Whether the NASDAQ's okay is something I have a question about because of this famous survivorship bias. But it gives you from 85. Oh, where's that? Where's the 1927 or whatever it was? And I'm so afraid that they're going to change this one day. So I'm not even going to save this. And then I go down, and here is the amazing thing. We look at, instead of monthly data, we look at weekly data. And here's what you got to do when you do all this rigmarole with this. And of course, I always say, well, I certainly have this on the Google Drive. It's a little bit of a pain to put all this crap on that nobody's going to look at on the website, but I do sometimes, okay? And what you do there is you change this little one here from Mo to week, and then you can change it to daily. And when you do this, I guess I'll do it all. I'm going to clear the sheets, and I'm going to read all. What a mess this is. Don't even get rid of the grid lines. What in the heck am I doing? Okay, and there's the DAX and all of that stuff. Now, when you do this, you can, if it's weekly data, you get it. There it is. Oh, how cool. And then once you have this, you can, of course, do something like this. You can type 1927. Let's get a little bit of practical here. EIS, put columns in, put 2021. You're not supposed to. Some guy, my poor friend Max, they said, oh, you're never ever allowed to use the mouse. Oh, you have to play it like a piano. Oh, God. And then we put let's put average if. Well, the first one's going to kind of be off a little, but of course, no, when you do the average if, we'll do it like this. We'll put equal year over here. Come on, and the 1927 average won't be so good. I have the calculation off, and we can put average if, and we can click on this one, How about adjusted close? It doesn't matter. Double click there. Shift F9 again. Take a log of this divided by this. And we get a 12% increase. And I put Shift F9 again. And I press Shift Control P because I don't have my generic macros open. Oh, another thing nobody ever uses. But I think somebody might have stole some stuff on this. Not exactly, but maybe. And where are we? Oh, no, wrong sheet. Of course, that stupid Excel doesn't let you go Control Tab from sheet to sheet ever, and that at least has this in it. And then come on. And then we'll put this in. This is from 1927, and then we kind of, you know, can copy these, and then I'm going to my Demadoran sheet. I started one early. Maybe it's kind of got the same data. Okay, and now, the first one's off. Shit. Oh, second one. What's going on? Oh, it's kind of like it's off by 1 year here. Okay, because maybe he took kind of the end of the year. Maybe I should have done that. I don't have to do this anyway because I did it already. And this is okay. This is the same thing I just looked at, and this I should put. I'll save this for you. Odor and oh, I just saved his picture. I wonder if this is here. Just a minute. You know what he did? He said the following. Did I get this here? There's this picture of Mr. Demadoran. Shoot! It's not on this computer when he was supporting the billionaires tax. I gotta put that on my website anyway. Okay, no, he was against it. He said, "Oh, the billionaires tax, that's the worst thing ever." Okay, I guess that's what happens if you teach in finance and you want the equity market risk premium to be really, really high. So here, this one is our new thing, and this one is his. Okay, and we get basically the same thing. In fact, if I did an index here, and I took this one times 1 plus this one, and I took this one times 1 plus this one. Okay, maybe there's something different in the way we took the end of the year, or I don't know, something else. But I got it. Okay, I was wrong. Just a minute. I gotta stop. I gotta pause the video because last time it worked. Great. Okay, well, I was wrong as usual. Oh, shoot. But it is kind of interesting that when we use the data that Yahoo gives you from the S&P 500, it looks a whole lot. Press F11 here. It looks like they're pretty darn similar, aren't they? But I guess if you look closely, the red line kind of is typically a little bit above the blue line. And what that says, it's kind of fascinating here. And it says, number one, if I took, this is the average of the rate of returns. And this one is, why don't we put this is Wahoo. And this is Ibbotson. And who knows? And now I'm starting at the same place and doing an index on the same place first of all, the average is different, but if we took this one divided by the one way up at the top here, then we say, well, let's count how many. And then once you count these, you know what you got to do is I guess they're 95 years, but we take them one to the if we take the first two years, we take one instead of two. So you raise this uh, up here to the 1 divided by 95 minus 1 minus 1, right? And oh shoot, what am I doing? And you raise it to the 1 divided by 95. Let's just raise it to it like that. And then maybe is this, you gotta do it like this. Sorry about that. And well, let's put this one minus 1. Okay. Do it right. Sorry about that. And so we get over a very long period that Yahoo, this is the IRR or the geometric growth rate or whatever in the heck you want to call it. And it's kind of interesting how different it is. The difference between this and this is 128 minus, oh my gosh, that's how much a difference in an IRR make. You might think, 9 versus 6, what's the difference? It's enormous when it's compounded. Okay, all right, maybe there's an arithmetic average or something going on with Ibbotson. Okay, and that's really not what I wanted to get to, and I'm getting a tiny bit off track, but I'm going to keep going. So now the next thing you do, okay, this was our weekly. And then for some reason, I guess I'll save this anyway. For some reason, when you go to daily, it gives you a third result. Our friends at Yahoo, who I love, I guess, because they don't charge me anything and I wouldn't pay for any of this stuff. And so now we go to the daily one. Okay, and I go to the one that says daily stock prices. And this time, what you do, okay, and this shows you how to use our little tool and mess around with it all. And this time I got S&P 500, Dow 30. Dow, it didn't start till 1992. S&P 500, I got Con Ed, GE, IBM, just a couple of companies that I knew existed for a whole long time. Then for some reason, why I got these, I don't, Facebook, I don't even know. Okay, and when we do the same thing, but let me go to this one, and then you put, where's our little thing here? Where's our little D? You put D here instead of, and just because the foolish consistency is the hobgoblin of a petty mind, I guess I put the D here instead of in a separate place there. But when you do the daily stock prices, then you get this. Okay, and you get it from 1950, but we got daily stock prices, and that means we can really start looking at things. Okay, now, there's some popcorn going on in the background, but that's okay. It's not going to irritate the video, that much, but I do want some. I would like to have some. Probably won't get it. Now, so what I did here, we can close this sheet, which is now changed my opinion on everything because I thought I was getting exactly the same for Damodaran as the other one, Mr. Supporter of Billionaire Tax. And no, Ibbotson, sorry. So then I just copied some data. Okay? And now let's do something simple. Let's start evaluating the time series aspects of this, of the stock. Now, I should have shown you when I got the volatility for the Ibbotson versus the S&P 500, it was virtually identical. To get the volatility, you take the change in the stock price and you take the standard deviation of the rate of change, and if you're kind of official about it, you use the log ln to get the constant standard deviation. Now, the first thing let's do is let's make a little thing where we kind of put these together. Let's get rid of all this crap. This another thing that I'm sorry, I do kind of like Yahoo is that we can get this data, but and what happened to IBM? I'll just do these two. And in fact, what I'm gonna do is just start in 1962. I hope you don't get mad about that. 1962. Let me see what happened in 62. The Berlin Wall was there for a little while and blah, 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 blah. Okay, so let's take GE. Well, this is our GE, and let's put the Con Ed next to that and the S&P 500 next to that. In fact, maybe we'll do it later, and then we'll just look up. I used to do it with some sort of match index. How ridiculous was that? We'll just look up wait, this was, come on. This is because I've got some other computer. Equal lookup. And let's go and get this one. I forgot which one we were getting. And we take this. And we take this. And there's our first one. And then we take lookup here. And we take this one. And we go to S&P 500. And we want a little bit of different dates. And of course, I was an idiot and didn't take the whole line. And nobody's ever proved to me that there's anything at all wrong in these kind of situations with doing this. Okay? And then let's take the change. Well, maybe we'll do it like this. Okay. Let's put values here. And let's take the same thing. So I'm going through this, and if it's a little long, I'm really sorry. Maybe that's why nobody looks at these things. And then we to change. Okay, and to get the change, let's do our ln of this divided by this, and kind of take it over and do this. And then maybe, how about this? Let's for once put it up here because I don't want to look at those whole things. Let's take the STD DEV. And when we do this, we should take the STD standard deviation of the sample. Okay, we're looking for the theoretical one, and there's our standard deviation of this is, and I hope this is the daily standard deviation. Now let's go over here and let's start doing we're going to make this on an annual basis and then on a month by month basis. And I think what we need to do is just a couple of other things. Okay, let's get let's put a start. Now let's put the year. Okay, and let's start year and then the end year. Okay, and let's put the start year as how about we'll start in 1957. I wonder why. In 2020. and just put a little bit of a and. Whoops, let's put the year here. Okay, and shift control and that little thing to the left of the 1. Left, that's right. And this is greater than or equal to this. And this is less than or equal to this. Okay, and then we can do all of our analysis in different periods. And all we have to do with this one is put if this thing, and let's press that 4 a couple times. Okay, and we leave falses. Did I put it in the wrong place, in the right place? Yes, because I'm going to copy it across and I want to keep it on column C. Okay, so I had to talk to myself about this. And when you do that sort of thing, the nice thing, okay, what did I do? C is, isn't this supposed to be greater than? No. Yes, and 1957 was a kind of stupid year, wasn't it? Let's put it, let's go to the 1984, up when they took the Berlin Wall. 89. How's that? Okay. And then we get the different volatilities. So you can see right now whether this stuff is stable or not. Let's put 1970. Okay, 1978 disco, and all that. Okay, I'm looking at the standard deviations and see if they're positive, kind of changing, and then let's also get a index. Okay. Why am I doing it like that? And then let's put our 1, 1, 1. And we take this one times 1 plus the change. And did I do that right? I think so. And the nice thing, when we use that little true false thing, it doesn't take very long, does it? So I'm trying to show you something a little bit practical, and hopefully we'll get to the disco period here somewhere. There we go. And we got it. Okay. And then, if we wanted to take the let's put over here the IRR or the compound growth rate or the geometric rate of return or something like that. But first, let's put the difference, the years. Okay, let's put years here, and let's take this minus that. Now, if this was 2019, you get 1. Okay, and is that right? This was 2019. We get 1, and if we raise it to the first power, so we don't have to do an adjustment. And if we want to take so all we have to do is take the this one, and we go up and divide it by this one. Oh, somebody said, gotcha. Oh, I don't know how to calculate anything. Okay, so we take this one and we raise this one. We raise this one raise it to the 1 divided by this F4 power minus 1 down there, and you got to put this in a little thing like that. I can't believe this. And then let's put F4 there, and then put a minus 1 at the end. Okay, this is kind of interesting. This can't be right. Yes, it is because it's GE. We get the utility having the higher return. If we stopped in 2000, started in 1962, maybe we get a very different picture, and we'll push this down here. This is kind of interesting that just gave us, let's put it 90, okay, and I'm kind of suspicious of the GE thing. Did I take that wrong? Let's make our little graph now. If we wanted to make a graph, why not? Why not? What we do here is we put if, and you go to this thing, and then you put the date. Otherwise, you put NA, and it's a big deal to use the date. Of course, it's a really big deal to use the NA. And you have to format it, okay. And then we press F11 or something, and I totally messed up because, okay, what did I do wrong? Did I do the crime of crimes and not put the things here? Okay, and I think I might have to just do a little bit more. So I'm sorry if I'm going through too many graphs, and I really have to get to the point, and I know that I'm going to get yelled at. I don't want to get yelled at again. Oh no, no, oh shoot, just a second, oh no, okay, oh, damn. Oh, I'm so nervous about this video. Then they're going to give me dislikes. No, 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 no. I don't want to start yet. No. Okay, I'm finally back. And this, I can tell you, there's a whole lot of things that are my fault. But this one really wasn't. So for some reason, when I pressed F11, my favorite little thing to do, I remember when one lawyer said the only thing she learned in my class was F11, and I was so happy. I'm not so happy, but it was an interesting comment. This is S&P. This is our boring old utility stock. This is GE before 2000. If we go from the year Kennedy was killed to, let's see, 1979. We get a different kind of pattern, obviously, and that's interesting. They cut a dividend. I remember this was a really big event when a utility stock cut a dividend, and you can get all these. Maybe that's too thick, and kind of before that, it's interesting how GE had followed the S&P 500, and then if we go from 1979 to about 2000, then GE had its kind of wonderful period, and then if we go to 2021, kind of it doesn't look quite as good for poor old GE. Okay, so we've got very different stocks. Now we're going to look at some of the time series characteristics of these stocks. Now, if I go over here, and now we've done this, we're going to do this whole thing it's basically repeating what I'm done on an annual basis. We've got it on a daily basis. Let's do it on an annual basis. And we're going to do it on a monthly basis. And this is really, I'm finally getting to the whole theme that when you look at this, you're going to get different volatilities. And in theory, if there was no mean reversion, you wouldn't get any different volatilities. Number one, that says that there's something funny going on. It's not as perfect a random walk as we all thought it was when we used to have to study this kind of stuff. And then the betas are going to be different too. So I might have to, let's see how fast we can do this. So we put 1962 and all TIS, and we go to 2021. Up. Okay, Alt EIS, Alt C, tab a couple of times, 2021. Okay. And then let's put an average if. I think that's the one to use. And we go to our year column and we click on this one. And then we get our 3 companies. And I think that's not going to matter that I have that number right up at the top. Okay. And this is our price. Okay. Of course, I've got to do this. That's that one, and then we don't do the rest. Okay, excuse me. Okay, and then when we do this, then we'll do our little thing again. I guess I'll go ahead and put it here. So of course we've got our 3 companies. I'm worried about the stupid titles. That was really idiotic. Okay. And then we'll put our and. Now when I have made these mistakes, this computer doesn't have a little greater than or less than sign. That's my problem. This thing is greater than or equal to this, and this thing is less than or equal to that. Okay? And I have to talk through it myself sometimes, like this, and then we'll do the same thing. This is our price. Okay, and then we'll do our change. Okay, and when we do the change, now it's finally going to start to get a little more interesting and not just the old Excel crap. And we put, if this is true, then we take the log ln of this divided by this. And if somebody says, oh, you took the log, you can't do that, that's why it's giving you that bullet. That's crap. Okay, if that's, then we take the log of that. Why didn't it kind of finish? ln, and I guess I have to put if, okay? And then we can just go here. And now, the other thing we should do is we should do over here, we've got to count how many days there are in the year, and if we use COUNTIF, and we count if we take this range over here, right? I'm doing this, I have to remember how to do this, okay? There are 252 days, that's what it's supposed to be. Sometimes there are 254, 253, okay. Let's take an average of that, okay. Now, if you follow the theory, and I hope I've through it's 251.28 days. If you take the standard deviation, and then we let's go over here and put annualized, and all we do is we take this thing and we take the square root of it. Let's put it like this: QRT of this one. And then we multiply that, and this is this business of, because it's variance and all that stuff, multiply, that's above the 8, I think, right? And then we get our volatilities of our shares. Interesting that this supposedly safe utility didn't have it. And let's go and put 1963 to 2021, and we get our volatility on a daily basis of 16%, 20%, and 27%. I'll watch this whole thing not work. And then I obviously did something wrong with this one because I didn't put the dollar sign over here. I'm sure all our Kenny Fast people are saying, "Oh, you idiot," because they're not even watching this video anyway. Okay, and then we get, now I'm going to get our volatility here. And now I was going to do all sorts of I was going to, oh crap, no, my Janelle. Yes, I'm going to open it. Sorry. Sorry. And I'm going to not do this now. Okay. Then I was, going to do all sorts of Monte Carlo simulation to try to figure out what's going on. This is our volatility, and this is our annualized volatility here. And if they were working the same way, now I have done that. If it was truly a random walk, independently, identically distributed, blah, 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 you wouldn't get this. You wouldn't get the difference in the volatilities. Now, interestingly, the difference here is bigger than the difference here. And we just did an average. We just did an average of the stock prices. And when we get an average for the year, and maybe if you take the end of the year, maybe you don't get the same kind of thing. Okay, and when we do that, now let me see. Each time we get a lower number. Each time we get a lower number for the volatility on an annual basis relative to the volatility on a daily basis. Okay, now I'm going to do this on a month by month basis. To do this on a month by month basis, I'm just going to do this. I'm just going to show you how to do one thing. I really got to get rid of this graph. Maybe I kind of like it because it was such a pain to do. Where should we put it? Maybe I'll make it smaller. And I was promising not to burden you with all of this crap. But what we do here is you just put equal EO month of this. And then the EO month, it's kind of you're going to do the same thing kind of with the average if. And you're going to get the end of the month for each of these things. And then when we go over here, we're going to start with we'll start with the first date. Okay. Why didn't I put the shift control 3 on that one? And then we put EO month again. Yeah. I think we know EO month here. Come on. I'm gonna cry. Oh shit. EO month. Oh my god. I'm not supposed to ever swear on these. I'm not gonna say that they're okay for kids. Equal EO month. And when we go here, we put comma 1, and then we do it here. And then I'm going to go all the way down, and then I'm going to do my average if, and I'm going to put the volatilities in again. And I'm going to pause the video finally, and then we're going to do the same thing for, use those to get the betas. I didn't mean to do that. Okay, so I've done a little work. And let me see, what did I do? Okay, we put the month here, and we went down to 719 months. We got the average stock prices for the month. You could I suppose, argue that you should get the ending, but I got the average. I'm not going to argue that. I'm not going to get into that argument right now. And we got the 3. And then just like before, we got the percent change. And then this time, when you compute the volatility, you get the volatility and you take the square root of the number of periods it takes to make up a year. So for the for the daily, it was 252, and all that. And for this, it's 12. So in this case, we didn't have to do it because we have one period per year, and the volatility of I should have put our kind of names here, maybe. But I'll do it like this. And the volatility is pretty similar. The volatility of the S&P is less than the 2 individual stocks. You can argue that's the whole business of diversification, perhaps not in this case. I'm not absolutely sure. And we get the similar volatility. But when we did this volatility for the daily analysis, we get a higher daily volatility than the volatility when we take the average over the course of a month, or the average over the course of a year. Perhaps I'm going to do this not with the average, but the year end or the month end, and then maybe I'll just put it on the website or do something. Yeah, no, I'll stop. I'm going to do that right now because I'm really worried about that. Oh, shit. Now, when you do this without an average, when you do this on this is on the end of the month, at the end of the period, what happens is you get a very similar volatility then. Now, maybe somebody's going to comment it, probably not, but when you do this and you just pick one number that it can move all craziness within one little period, and you don't average it, the idea about averaging it is exactly the point. So I'm not going to use this. I'm going to go back to our averaging. All right, and I really have to. I should have done something. Perhaps somebody else knows this. Perhaps it's obvious. Oh no, just a second. What the heck is this? Okay, it's at the end of the month or the end of the period. So when Yahoo gets this and gives you this, they're not averaging. I didn't mean to make such an idiotic statement. Now let's do the final thing. Now let's get first of all, let's get 5 years of data. So let's say we start in 2020, we stop in 2020, and we go back 2020, 19, 18, 17, 16. And I had to count on my fingers for that. And that's, it's really 5 years if we include the years. And then if we want to get the beta, well, we're not going to get the beta of the S&P 500 because we get it on itself. All we do is put the slope, and we get the slope of the known y's, which is our stock, and we get the slope of the known x's, and then we get a 0.48 beta. And for GE, it's a lower beta. It shows you how much they know given what happened to the risk. And when we do this on an annual basis, okay, we would get a slope here equals slope And nobody would do this on an annual basis. I almost said of course, but that would be kind of a jerk off thing to say. It's really not. We get a negative beta, and we get a gigantically different beta, and we've only got 4 periods of data, so that might not be good. But the way this is commonly done is to get a monthly beta. And this is how, when Yahoo reports the beta, I've gone and computed and verified all this, well, a little bit at least. We take the slope of the stock, the change for the stock, okay, and we take that against the thing, and then we get 0.12 versus 0.48, which is correct. Let's do it for GE. Now, there's also all this debate about whether betas change or not. So we can start looking at that a little. And then we get a much higher beta for GE. Now, this, for me, it's if we're, let's just talk about it. I was going to try to do Monte Carlo simulation and really try to prove this and go crazy with this. If you're going to diversify a portfolio and hold a stock, you're not looking at these short-term kind of in-the-day fluctuations. You're holding it for a long time, and you want to see what's going on with the movements of the stock over a period of time. And if the behavior changes when you average something over a month versus you average over a day, you should take this one. Now, let's go back to 1963 and pretend we're not doing this over 5 years. Then we get a higher beta here, and I should do this one. So 0.49. It's not as dramatic. That's okay. Let's try 1990 to 1995. I guess we'd have to do 1994. Oh, where did I put it? 1994. And the first issue is you really do get different betas. This time 0.78 versus 0.36. If you're arguing for a higher beta, you'd use this. And then you get a lower beta. You get a lower beta. And we should really try to evaluate, especially for this con ed, whether this beta really changes over time. Let's take 2000. Ah, come on. Let's take 2000 to 2004. Okay, and now interesting. They're almost the same betas here, and these are giving us crazy numbers. And we get again this number, and this is the one that would classically be reported. It's very different. We need to explain, and I hope I've explained it a little bit, that when you have a longer period, you're taking out these fluctuations, that the kind of trading fluctuations. Let's do, oh, man, was that a crappy explanation. I'm going to pause one time and then finish this off, and we're going to